Hi, I'm Rudy Luco with Morningstar Canada. I'm here with Charles Brandis, Chairman of Brandis Investment Partners, which he founded 40 years ago in San Diego, and which currently manages an estimated $33 billion, and those assets include the Bridge House family of funds here in Canada. We're going to be talking today about active versus passive investing. And I know, Charles, welcome, which camp you're in. Low volatility strategies and passive strategies in general are clearly not your style, but what's wrong with trying to control risk or having broad market exposure through these strategies?
What's wrong with trying to control risk, if you're defining risk as this stock market volatility, then you are making yourself into an investor who is more concerned about stock market volatility and not concerned as a real investor in the businesses and how they do over a long period of time. And so that's one of the things that, in my opinion, is wrong with it.
Yeah. So if you're limiting risk, you're really limiting your return. Is the message?
Yes.
So. But is there a place for these strategies, though, that low volatility investing, for instance, it might be suitable for someone who has a shorter time horizon or is trying to, match liabilities with,
Absolutely. There is a place for that. If you're going to not be able to think very long term, and by very long term, I think in terms of 5 to 10 years as a true investor. But if you need the funds and if you have to pay out the retirees and that sort of thing, you have to consider the volatility on the short term. That's absolutely correct. And you have to mitigate that as much as possible.
You've spoken of the risk of a herd mentality in passive investing. That was one of the issues that you raised at a conference in Niagara-on-the-Lake when you were speaking to an institutional audience. What do you mean by that?
I mean that what we have seen since the 2008 and 2009 decline is a very large amount of money and funds in pension plans and endowment plans and retirement plans that have given up trying to make distinctions about what is a good company and what is a bad company and what is a good investment and what is a bad investment. And when you do that, you are really taking your load of capital that you have in that fund and saying, I'm not going to use it for free enterprise anymore. I have all this capital, and free enterprise needs that capital and makes distinctions about what would be a good company and increasing efficiency in the markets, and they just give up totally and say, we'll just buy everything. There are some reasons to do that, but I think that we should, as owners of capital and as advisors to capital, we should still try to make that capital do as well as it can in helping businesses and the economy grow.
So there is a kind of a social responsibility argument that you're making there, that if everyone did this, everyone just indexed, we'd all be worse off.
We would be considerably worse off if everybody indexed. That's correct.
However, an individual investor or perhaps even an institution doesn't really think that way. They sort of think, well, what's going to be best for me or best for my clients? And there is the argument that's made by the indexers that if you buy the entire market and you have a very low cost price point, that you're going to do better than average. And how do you respond to that?
I would say that you're just giving up, and you shouldn't do that. You should try to do better than average, because that's what makes economies grow. And I think that just giving up, from a standpoint of an active manager, I like that. I don't have any competition then if everybody gives up. But I don't think it's best for the economy.
Yeah. So there is a positive side then that if the market gets a little flabbier and there's a misallocations of capital, that it creates opportunities for active investors who have a solid discipline.
Yes, I could put it that way.
Yeah. If you take the active route, though, and you put together a portfolio that's a lot different from the market, you're either going to do one of two things. Probably you're either going to outperform the market, which is good, or lag the market, which is not so good. And and so there is a market risk there. So it leaves people with needing to differentiate between skilled managers and non-skilled managers.
It does. It requires you to be able to do that and to at least attempt to do that. Yes. But if you really want to do well, you can't be doing what everybody else is doing or indexing or just be part of the group, obviously. And there's only one other thing to do well, and that is to be fundamental. Because there's so much that goes on in the investment world that is not fundamental, but is short-term oriented trading, zero-sum games, derivatives, all sorts of things that are not really fundamental what builds new wealth. And so you can stick to things that are fundamental, buy companies that build new wealth and get them at reasonable prices, and over a period of time, you're going to do very well.
Mm-hmm. Yet there is still that period of how long do you have to wait? Potentially, if value style is a patient style of investing, that's been your style. That's going back to Benjamin Graham and all that. And that if you're buying out of favor, unloved stocks, they might well stay that way for quite a while. So
that's
really
true.
The question is, well, how long do you have to wait?
Anywhere from 6 months to 1 year to 10 years.
Yes, yeah, and even after 10 years, there's been some very disciplined value managers, and those have included even some of your retail funds that they're below average after 10 years, so it might even take longer than that, can it?
Usually it does not,
No.
but in some circumstances it can, but that's very unusual.
Thanks, Charles. It's your 40th anniversary of the founding of your firm, and congratulations on that, and enjoy your stay in Toronto. And thank you for watching. For more on investment and personal finance, please keep coming back to morningstar.ca.